Should you sell all your crypto at the end of 2025? Are we just months away from the end of this crypto bull market and the start of a brutal crypto winter? Well, this video will be the ultimate guide on exactly when to sell your crypto, whether you should think about selling in the final few months of this year or if you should hold on into 2026. The biggest question in crypto right now isn't whether we're in a bull market, it's whether this cycle will end like every other cycle before it, or if we're witnessing something completely different. For years, the 4-year pattern has been crypto's most reliable playbook. 2013, 2017, 2021, each cycle peaked in the final months of the year before collapsing into brutal bear markets. If history repeats, we should be preparing for a top in the next few months. But this cycle has already broken several traditional patterns, and some of the smartest minds in the space are suggesting we might be looking at an extended timeline that runs deep into 2026. One of those voices belongs to Raoul Pal, former hedge fund manager, founder of Real Vision, and one of the most respected macro analysts in crypto. His latest analysis suggests we're not even close to a cycle top. Instead, we're in what he calls a waiting room phase before the real explosive gains begin. In this video, I'm going to break down both sides of this debate, the historical case for a 2025 peak and Raoul's compelling argument for why this cycle could be fundamentally different. We'll explore what institutional buying really means for the cycle, why the traditional signals might not apply anymore, and most importantly, what this means for your portfolio exit strategy going forward. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's start with what Raoul Pal is seeing that most people are missing. Here's Raoul Pal explaining exactly where we are in this cycle and why patience is the most important thing right now.
Hey everyone, look, I know it's a bit chaotic in markets and many of you are first cycle in crypto, and I know that you need a bit of guidance and a bit of reassurance that everything's going to be okay. Listen, all of us have our lives and dreams in this whole kind of banana zone thesis. It all matters. We're all trying to unfuck our future.
What Raoul is describing here is the psychological reality that most crypto investors are facing right now. The market feels uncertain, volatility is high, and many people are wondering if they should take profits or hold for bigger gains. But according to his analysis, we're still in the early stages of what he calls the banana zone, the period where the most explosive gains typically occur. Pal's framework is built on something he calls the everything code. The idea that crypto cycles align with broader macroeconomic patterns, including global liquidity, business cycles, and institutional capital flows. Right now, his models are showing that we're nowhere near the euphoric peak that typically marks cycle tops.
We have a framework, it's there to help you. We are still early stage within the final year of the crypto bull market when a lot of the big gains come. It's time not to lose your shit. Have patience. See the bigger picture.
This is a crucial point. While many investors are focused on short-term price movements and getting nervous about potential corrections, Pal is emphasizing that the structural setup suggests the biggest gains are still ahead of us. The key is maintaining the right perspective and not getting shaken out by normal market volatility. One of the strongest pillars of Raoul's thesis is global liquidity, the total amount of money flowing through the global financial system. Here's his take on how this is setting up for crypto.
Global M2 back in 2017, exactly following this cycle. Same kind of administration with the same tariff policies. Dollar reacted the same, the markets reacted the same. So again, don't expect these to be perfection, but expect this to start playing out again. If this is the case, then M2 is going to keep going up all fucking year. If that is the case, then crypto and risk assets like tech will do well all year.
What Pal is describing here is incredibly important for understanding why this cycle might extend beyond traditional timelines. Global M2 money supply, essentially the total amount of money in circulation worldwide, is following a similar pattern to 2017, but with some key differences. The 2017 cycle saw massive liquidity expansion that drove crypto from a niche asset class to mainstream attention. Now we're seeing similar liquidity conditions, but this time it's combined with institutional adoption through ETFs, corporate treasuries, and regulatory clarity that didn't exist in previous cycles.
So financial conditions are kind of the big daddy of all of this. And the 3-month and 3-month rate of change of Bitcoin is driven by financial conditions, which leads by 3 months. So financial conditions obviously tightened because of the dollar and rates back in last year. Now Bitcoin has fully priced that in. So we're at the price point that is right. Now,
this is where Pal's macro background really shows. He's not just looking at crypto charts, he's analyzing the underlying financial conditions that drive capital flows into risk assets like Bitcoin and Ethereum. According to his analysis, the tightening that occurred in 2024 has been fully priced in, and now we're setting up for an expansion phase that could last much longer than the traditional 4-year cycles. Here's where Raoul's analysis gets really interesting. His view on how the business cycle is extending this crypto cycle well into 2026.
My view is that the business cycle is taking a long time below 50. It's starting to expand now. That has probably extended the cycle into 2026. Not a guarantee, not yet a prediction, but is what is in my head because of the structure of the business cycle. So we can probably keep going longer, and that will still give us much higher prices to come. So the game is all to play for. It is a game of don't fuck this up. It is a game of understanding the rules, understanding to have patience, and stepping back, zooming out, touching grass, touching sand, and let it play out. All of our futures are resting on the same thing. I take this very seriously. I'm doing my absolute best, along with Julian, to guide you in this.
This is perhaps the most important insight in Pal's entire framework. Traditional crypto cycles have followed roughly 4-year patterns, but those patterns were based on different market structures and economic conditions. Now, with the business cycle taking longer to recover and expand, Pal believes the crypto cycle will extend well into 2026. The ISM index that Pal references is a key indicator of business expansion. When it's above 50, businesses are generally expanding. When it's below 50, they're contracting. The longer it stays below 50, the more pent-up expansion potential builds up for when conditions improve.
Rising ISM will be good for your bags. And rising ISM it may still be choppy because we're still coming through. We need rates to go lower. But as that happens, we will see this pick up.
What this means in practical terms is that as business conditions improve and the ISM rises above 50, we should see increased demand for risk assets like crypto. But because this expansion has been delayed, it could create a longer and potentially larger cycle than we've seen before. The biggest difference between this cycle and previous ones isn't just timing, it's who's driving the demand. Here's what Raoul sees in the institutional adoption picture.
As the business cycle accelerates, people go further out the risk curve because they have more money. You're earning more money, your mortgage has gone down, you have higher savings, you can recycle them into assets. It happens at corporate level too.
This captures something that many retail investors don't fully appreciate. Institutional adoption isn't just about Bitcoin ETFs, it's about a fundamental change in how capital allocates to crypto during expansion cycles. In previous cycles, crypto rallies were primarily driven by retail FOMO and speculative leverage. Now we have pension funds, endowments, and corporate treasuries systematically allocating to crypto as part of their long-term strategies. This creates a completely different demand profile, steadier, larger, and less prone to panic selling. The numbers back this up. Crypto ETFs attracted $29.4 billion in inflows through August 2025, with Bitcoin treasury companies like MicroStrategy and newer players accumulating massive positions. Bitmain recently made headlines with a $2.2 billion Ethereum purchase, signaling that institutional appetite extends beyond just Bitcoin.
Altcoins should outperform in the next phase once we get out of this corrective phase. Okay, let's look at these corrective phases.
This is where Pal's cycle analysis gets really interesting for altcoin investors. Traditional cycles see Bitcoin lead, followed by Ethereum, then broader altcoin adoption. But with institutional money now flowing into multiple assets and treasury companies diversifying beyond Bitcoin, the altcoin rotation could be both larger and more sustained than previous cycles. One of the most overlooked but crucial factors supporting an extended cycle is the massive growth in stablecoins. Here's why this matters more than most people realize. The stablecoin market has exploded to over $280 billion in 2025, more than doubling since the beginning of 2023. This isn't just a number, it represents dry powder sitting on the sidelines ready to flow into crypto assets. Unlike previous cycles where new money had to come through traditional banking rails, stablecoins create a massive pool of readily deployable capital within the crypto ecosystem. McKinsey analysts project the stablecoin market will surpass $400 billion by the end of 2025 and potentially reach $2 trillion by 2028. This creates a structural change in how crypto markets function. Instead of needing external capital inflows to drive rallies, there's now hundreds of billions of dollars already tokenized and ready to rotate into risk assets at any moment. The regulatory clarity provided by the Genius Act in July 2025 has been a game changer for stablecoin adoption. By requiring full one-to-one reserves and public disclosures, it's given institutions the confidence to hold and use stablecoins as part of their treasury operations.
If this is going to go from $3 trillion as a market cap to $100 trillion, we want everybody to make as much money as possible, and we can fuck it to the banking system and everybody else. We deserve this. This is our system. It's made for us, and it's ours to capture. Help each other out is the key thing, and not fight with each other.
This quote captures something important about Pal's long-term vision. He's not just looking at this as a trading opportunity. He sees crypto as fundamentally reshaping the financial system. With that kind of structural change, traditional cycle timing becomes less relevant than the broader adoption curve. Despite all of the structural changes, market psychology still plays a crucial role. Here's what Raoul is seeing in current sentiment indicators.
Fear and greed. Everyone's fearful as shit right now. It collapsed down to 20, so super fearful. Again, these tend to be good inflection points to start thinking about absorbing.
Although the fear and greed index has recovered from the 20s, it is still very low, now sitting in the 40s. This is a classic contrarian signal. When the fear and greed index drops to extreme fear levels, it historically marks good buying opportunities rather than times to sell. The psychology of the market is nowhere near the euphoric extremes that typically mark cycle tops. Compare this to previous cycle peaks. In late 2017 and late 2021, the fear and greed index was consistently in extreme greed territory, often above 80 or 90. Social media was filled with stories of massive gains, celebrities were launching NFT projects, and your Uber driver was giving you crypto tips. None of those conditions exist today.
These phases of the banana zone, I get so fed up with people online going, where's my banana? Your banana fell over. Your banana's not ripe. Your banana, blah, blah. The banana zone is a period of time that lasts a year. It is not an instant gratification. You guys need patience more than anything else.
This is perhaps Pal's most important message for crypto investors: patience. The banana zone, his term for the period of explosive crypto gains, isn't a single moment, but a process that unfolds over months. Most investors get frustrated during normal corrections and miss the real moves because they're expecting immediate gratification. Now let's address the elephant in the room. What if you're wrong about cycle timing? What if you sell at the wrong time, either too early or too late? Well, here's Raoul's framework for thinking about risk management and selling some of your portfolio without abandoning the opportunity.
I talked about we could take lifestyle chips off sometime in the first quarter. Looks like it's pushed out to the second quarter. I'll keep you updated when that happens. But again, I'm very chill about this.
This is a crucial point about position sizing and risk management. Even if you believe the cycle extends deep into 2026, that doesn't mean you ignore risk management entirely. Pal's approach is to take some profits, what he calls lifestyle chips, when targets are hit, but keep the majority of positions running for the bigger moves. The key insight here is that trying to time the exact top is a fool's game. Instead, the focus should be on participating in the majority of the move while taking some risk off the table at logical points. For most investors, this means having a plan for partial profit taking rather than trying to go all in or all out.
When you zoom out, Bitcoin is just retesting where it broke out from. That's it, guys. It's hardly a big deal.
This perspective is crucial for maintaining sanity during volatile periods. While day-to-day price movements can feel dramatic, the bigger picture shows Bitcoin holding well above previous resistance levels and maintaining its long-term uptrend. So when does Raoul actually expect this cycle to peak? Here's his latest thinking on timeline and what to watch for.
My view is that the business cycle is taking a long time below 50. It's starting to expand now. That has probably extended the cycle into 2026. Not a guarantee, not yet a prediction, but is what is in my head because of the structure of the business cycle. So we can probably keep going longer, and that will still give us much higher prices to come.
This is the core of Pal's extended cycle thesis. Unlike previous cycles that peaked in the fourth quarter of the post-halving year, this cycle could run into the first or even second quarter of 2026. The key driver is the slower business cycle recovery, which is keeping liquidity conditions favorable for longer periods. What this means practically is that investors have more time than traditional cycle analysis would suggest. Instead of feeling pressure to take profits by the end of 2025, there's potentially another 6 to 12 months of bull market conditions ahead.
But the back end of March, we should start to see prices accelerate, and then April, May, June, we should see some really significant price action as the second phase of the banana zone kicks in.
This gives us specific periods to watch. According to Pal's analysis, the key insight is we are on the brink of the second phase of a multi-phase cycle that could extend well into 2026. This creates multiple opportunities for both profit-taking and reaccumulation rather than a single do-or-die moment. Based on everything we've covered, here's how to think about positioning for a potentially extended cycle into 2026. First, if Raoul's thesis is correct, the traditional sell everything in Q4 2025 approach could cause you to miss the majority of the cycle's gains. Instead, consider a more nuanced approach that takes partial profits at predetermined levels while maintaining core positions for the bigger moves ahead. Second, focus on position sizing rather than timing. The extended cycle thesis doesn't eliminate volatility, it just suggests that the overall trajectory remains upward for longer than traditional cycles. This means having enough dry powder to buy dips while not being over-leveraged during corrections. Third, pay attention to the quality of your holdings. An extended cycle benefits the assets with the strongest fundamentals and institutional adoption. Bitcoin, Ethereum, and select altcoins like Solana are more likely to participate in sustained uptrends than speculative meme coins or projects without real utility. Fourth, watch the macro indicators that Raoul emphasizes: global M2 growth, ISM readings, and financial conditions. These leading indicators can give you advance warning of when cycle dynamics might be changing, allowing you to adjust positioning accordingly. Finally, remember that even extended cycles eventually end. Start thinking now about what your exit strategy looks like for different scenarios. Whether the cycle peaks in the fourth quarter of 2025 or extends into 2026, having a plan removes the emotional pressure that causes most investors to make poor decisions at crucial moments. The bottom line is this: while the traditional 4-year cycle has been remarkably consistent, the structural changes in crypto markets, institutional adoption, regulatory clarity, and massive stablecoin growth suggest we might be in uncharted territory. Raoul Pal's analysis provides a compelling framework for understanding how these changes could extend the current cycle well beyond traditional expectations. Rather than fighting the last war by assuming this cycle must end like previous ones, consider the possibility that we're witnessing the evolution of crypto from a speculative asset class to a permanent part of the global financial system. If that's the case, the traditional rules might not apply anymore. And if you want to stay ahead of these macro shifts and understand exactly when market conditions are changing, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights on everything from Federal Reserve policy to on-chain metrics, all delivered straight to your inbox. You'll get clear analysis on when to buy, when to take profits, and the macro trends that could move markets. Just click the first link in the description, enter your email, and you're in. The next 12 to 18 months could be the most important period in crypto's history. Whether you believe in the traditional cycle or Raoul's extended timeline, the key is staying informed, managing risk appropriately, and not letting short-term volatility shake you out of what could be generational opportunity. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.